Every trader begins with a vision, a spark of possibility that ignites the imagination. It's the tantalizing notion that a single, perfectly executed trade could rewrite their future. Night after night, they sit hunched over screens, eyes stinging from the relentless glow of candlestick charts, hearts racing with every flicker of price movement. The dream is seductive. Transform a modest $100 into $10,000, then catapult that into a six-figure fortune, bidding farewell to the monotony of a conventional 9-to-5 life. Yet what most traders fail to grasp is that this dream doesn't crumble because of market volatility or unpredictable price swings. It collapses under the weight of their own mindset. In the early days, a trader's mental framework is tethered to survival, where every trade feels like a referendum on their self-worth. A loss triggers a cascade of self-doubt, while a win inflates their confidence, convincing them they've unlocked the market's secrets. This emotional pendulum, swinging between hope and fear, euphoria and despair, forms the true barrier between a small account and substantial wealth. Before we continue, make this commitment. This channel isn't about quick fixes. It's about developing traders with mental strength and discipline. If that resonates with you, join us. Subscribe now so you don't miss any of our upcoming videos. Stay until the end and keep progressing with us, one mindset shift at a time. This video isn't just another trading video, it's a mirror for your mindset. Like now, comment what resonates and stay until the end. Because one idea here could change how you think and how you trade. Let's go. Consider the reality. The traders who ultimately scale their accounts to impressive heights aren't necessarily armed with superior strategies or exclusive knowledge. Their edge lies in their mastery over their internal dialogue, the quiet voice that shapes every decision. Picture two traders, each starting with a humble $100, both equipped with identical knowledge of chart patterns, indicators, and currency pairs. They analyze the same markets, trade the same setups, and yet their paths diverge dramatically. One trader, driven by emotion, burns through their account in a matter of weeks, chasing impulsive trades and reacting to every market twitch. The other, guided by structure and discipline, methodically compounds their capital over a year, turning that same $100 into $200. The difference isn't technical prowess, it's mindset. The first trader is a prisoner to their emotions, treating every loss as a personal failure and every win as proof of genius. The second trader operates from a place of calm detachment, viewing trades as data points in a long-term experiment. Where the first reacts, the second responds. Where the first seeks validation, the second seeks consistency. When you're in survival mode, trading feels like a high-stakes battle for survival. Your brain, wired by millennia of evolution, interprets losses as existential threats, triggering the same primal fight-or-flight response that once protected our ancestors from predators. Each red candle on the chart becomes a jab to your confidence. Each dip in your account balances a visceral pang of pain. This heightened state of alertness distorts your decision-making. You move stop losses in a desperate bid to avoid defeat, snatch profits prematurely to secure fleeting wins, or skip promising setups out of fear of another loss. Every click of the mouse becomes a defense mechanism, a shield against the possibility of emotional or financial pain. But the moment you shift from survival to strategy, the game transforms. You begin to see trading not as a test of your worth, but as a game of probabilities. The pursuit of perfection gives way to the pursuit of consistency. You realize that a small, repeatable edge, executed with unwavering discipline, is infinitely more powerful than any elusive holy grail, indicator, or strategy. This transformation in perspective doesn't happen in a single epiphany. It emerges gradually, forged in the crucible of repeated trades, self-reflection, and hard-won lessons. It begins the moment you stop viewing your account as a fragile treasure to be protected at all costs and start seeing it as a tool to express your edge. Most traders claim they want to scale their accounts, But what they truly crave is the emotional relief of a winning trade, a fleeting affirmation that they are indeed good enough. This hunger for validation keeps them trapped in a cycle of small wins and smaller thinking. In contrast, the traders who scale to extraordinary heights operate from a different paradigm. They've cultivated a mindset that allows them to detach from individual outcomes. They can endure 5 consecutive losses without flinching, not because they're immune to disappointment, but because they understand that their edge manifests over hundreds of trades, not a handful. They've trained their minds to think like portfolio managers, not gamblers, focusing on long-term probabilities rather than short-term thrills. The irony is stark. You cannot scale your profits until you scale your discipline. A trader who doubles down emotionally will never double their account mathematically. You cannot trade large positions with a mindset rooted in scarcity or impulsiveness. You cannot grow your capital while shrinking under the weight of self-doubt. Here's a truth many overlook. Trading small and trading large are fundamentally the same game, distinguished only by the emotional stakes. The setups remain unchanged. The price action follows the same rhythms, and the market operates with the same indifference. The only variable that shifts is you, your ability to manage the intensified emotions that come with bigger numbers. If your psychology buckle under the pressure of a $100 trade, it will shatter when you're managing $10,000. Scaling, therefore, demands mental expansion before financial growth. Every trader, at some point, entertains the fantasy that a larger account would magically solve their problems. If I just had more capital, they muse, I'd be profitable. But this is a delusion. If you can't protect a small account, a larger one merely amplifies your flaws. Every fear, every impulse, every lapse in discipline becomes a magnified liability. The traders who rise to the top don't trade to escape their emotions. They trade to master them. They've constructed a process that filters out market noise, anchors them in patience, and prioritizes consistency over fleeting excitement. They don't rely on sheer willpower, which is finite and fickle. Instead, they lean on structure, a meticulously designed system of rules, routines, and habits that guide their actions, even when emotions threaten to derail them. This is why the winning mindset is rooted in humility, a quality often misunderstood in the high-octane world of trading. Humility doesn't mean self-deprecation. It means surrendering to the market's unpredictability. You cannot force the market to bend to your will, just as you cannot command the tides to obey. You can only align yourself with its flow, accepting that losses are inevitable, randomness is a constant, and mastery lies not in predicting the future, but in adapting to the present. Every successful trader undergoes this metamorphosis, from wrestling with the marketo, harmonizing with it, from reacting emotionally to executing mechanically, from obsessing over profits to perfecting their process. The market is a relentless teacher, punishing those who resist uncertainty and rewarding those who embrace it. It doesn't care about your dreams, your fears, or your need for validation. It simply is a vast, indifferent force that reflects your strengths and exposes your weaknesses. The difference between a struggling trader and one who scales isn't knowledge, it's acceptance. The struggling trader fights the market, desperate to prove themselves. The scaling trader flows with it, secure in the knowledge that their edge will prevail over time. If you're grappling with fear, doubt, or the urge to overtrade, know this: most traders don't fail because their strategies are flawed. They fail because their psychology is fragile. That's why I wrote Master Your Mind, Master Your Trades, an ebook designed to equip you with practical tools to tame your emotions, sharpen your discipline, and trade with the clarity of a professional. If you're ready to elevate your trading, check the link in the description or pinned comment to grab your copy today. Let's dive deeper. Ultimately, the shift from survival to strategy transcends trading. It's a transformation of identity. The trader who remains emotional, reactive, and desperate is striving to prove something, whether to themselves or the world. They trade for validation, for status, for escape. In contrast, the strategic, patient, and consistent trader has nothing left to prove. They've shed the need for external affirmation, trading not for money, but for mastery. One chases fleeting rewards, the other builds enduring wealth. Scaling isn't merely a financial milestone, it's an internal evolution. It's not about executing bigger trades, but cultivating a bigger mindset. The day you stop asking, "How can I make more money?" and start asking, "How can I think more clearly?" is the day your small trades begin to lay the foundation for extraordinary growth. This is where the winning mindset takes root, not in leverage or lot size, but in the quiet, unshakable confidence that consistency compounds and mastery always scales. The dream of transforming a small account into fortune burns brightly in every trader's heart. But few realize that the real challenge doesn't begin when you open your trading platform. It begins when you start winning. The moment you transition from $10 trades to $100 trades, your mindset shifts, often imperceptibly at first. The numbers on the chart remain identical, but their weight feels heavier. Every pip movement carries a loud echo. Every red candle feels like a personal affront. This is where most traders stumble, not because their strategy has failed, but because their psychology hasn't kept pace with the stakes. Scaling up sounds deceptively simple. Increase your position size as your account grows. But in practice, it's a psychological gauntlet, a battle against greed, fear, and the elusive balance of self-control. When you trade small, every decision feels light, almost inconsequential. You're focused, logical, and disciplined, allowing trades to unfold without micromanaging every tick. A loss doesn't sting because the financial impact is negligible, and a win doesn't inflate your ego because the profit is modest. But when you scale up, something shifts within you. Your attention sharpens, but your patience erodes. You begin hovering over the chart, second-guessing your plan, fixating on the money at stake rather than the setup itself. The chart hasn't changed, same pattern, same volatility, but your emotional lens has. This is the danger zone, where the pursuit of profit overrides the discipline that made you successful in the first place. The truth is undeniable. Your trading psychology must evolve before your position size does. If you scale prematurely, you risk sabotaging your progress. Not because of market conditions, but because of your own emotional unpreparedness. Most traders believe that more capital is the key to success, but what they truly need is greater emotional resilience. If your mind buckles under the pressure of larger numbers, you'll unconsciously undermine your profits and amplify your losses. You'll cut winning trades short, desperate to lock in gains that don't need protecting, and cling to losing trades, unable to accept the hit. This isn't a technical flaw. It's a psychological ceiling, a self-imposed limit that only you can break. To scale effectively, you must cultivate emotional neutrality, learning to view a $100 win with the same detachment as a $10 win. Your self-worth cannot be tethered to your profit and loss statement. Professional traders live by this principle. Trade the plan, not the emotions. They don't make decisions based on comfort or fear. They make them based on logic. And that logic remains constant. Whether they're trading $100 or $100,000, the wisdom of legendary traders like Jesse Livermore and Paul Tudor Jones underscores this truth. Position sizing is not just a risk management tool, it's a psychological anchor. It keeps you grounded when greed tempts you to over-leverage and shields you when fear urges you to abandon your plan. The purpose of scaling isn't to chase bigger profits. It's to train your mind to handle greater pressure while remaining calm. When you scale too quickly, your nervous system goes into overdrive, mistaking financial risk for physical danger. Your body responds with the same primal instincts that once protected you from saber-toothed tigers. Racing heart, sweaty palms, tunnel vision. In this state, clear thinking becomes impossible. You can't plan, you can't strategize, you can only react. And reactions are the enemy of consistency. This is why gradual scaling is not just a strategy, it's psychological conditioning. Each increase in position size should come only after you've mastered the emotional demands of the previous level. Think of it like weightlifting. If you leap from lifting 20 kilograms to 100 kilograms overnight, you'll injure yourself. But if you progress incrementally, your muscles adapt, your technique improves, and your confidence grows. Trading follows the same principle. Scaling too fast disrupts your mental form, exposing cracks in your discipline. But when you scale gradually, your emotional resilience strengthens. Larger trades begin to feel routine, and your mind aligns with your account's growth. This alignment is the cornerstone of sustainable scaling. Another critical aspect of scaling psychology is detachment from outcomes. Many traders assume that increasing position size guarantees bigger profits, but true scaling is about maintaining the same discipline regardless of the numbers. Your emotions should fluctuate no more than your strategy does. Trading 0.1 lots should feel identical to trading 1 lot, not in terms of financial impact, but in terms of emotional response. This is the hallmark of emotional mastery. Detachment doesn't mean apathy, it means balance. You care deeply about executing your plan, but you're indifferent to the outcome of any single trade. You celebrate following your rules, not the size of your profits. Because if you only celebrate wins, you'll unconsciously chase them, spiraling into reckless behaviors like revenge trading, over-leveraging, or emotional burnout. Every trader who scales sustainably learns to prioritize process over profit. They measure success by the precision of their execution, not the dollars in their account. This mindset is the bridge between small, consistent wins and large, consistent growth. When you can execute flawlessly at any size, the market loses its power to intimidate you. But there's a subtler truth few discuss. Scaling isn't a linear journey. You might scale smoothly from $100 to $500 trades, only to hit a psychological wall at 1,000. Your brain has emotional thresholds, points where the stakes feel too heavy, triggering physical tension or overanalysis. When you notice these signs, clenched jaw, racing pulse, obsessive chart watching, you've reached your current limit. The solution isn't to push through with brute force, it's to stabilize. Trade at that level until it feels mundane, until the pressure no longer disrupts your decision-making. Only then are you ready to scale further. Many traders falter because they try to muscle through discomfort, treating emotional resistance as something to conquer rather than understand. But you can't fight emotions with aggression. You tame them with conditioning. Gradual exposure to higher stakes desensitizes your nervous system. Much like a marathon runner builds endurance through incremental training. Professional traders who manage six-figure positions didn't start fearless. They became fearless through repetition, training themselves to stay calm under pressure. The true power of scaling lies in self-awareness. Each new level of risk exposes hidden weaknesses in your psychology, impatience, greed, or lack of confidence. Rather than ignoring these emotions, study them. They're signposts pointing to your next area of growth. If your fear of loss intensifies with position size, it's a signal to deepen your trust in your system. If greed takes over after a big win, it's a reminder to reinforce your discipline. So how do you scale without losing control? Start small, build consistency, and increase your position size only after proving emotional stability over 20 to 30 trades. When you scale, don't fixate on the money. Focus on execution. Remind yourself that the chart is blind to your lot size, and the market doesn't care whether you're trading $10 or $10,000. Only your emotions register the difference. The traders who reach the top don't scale their trades, they scale their mindset. They master patience, hone their control, and cultivate emotional resilience. They don't chase instant riches, understanding that true wealth is built on psychological stability. Scaling a small account into a fortune isn't about growing your capital. It's about growing your capacity to remain calm when the stakes rise. The moment you realize that emotional control is your greatest leverage, everything shifts. You stop comparing yourself to others, stop forcing growth, and start respecting the process. The discipline that made you consistent at $100 becomes the foundation for thriving at $10,000. Consistency is the most misunderstood concept in trading. Everyone claims to want it, but few grasp what it truly demands or how it feels to embody it. It's not about racking up profits every day or avoiding losses altogether. True consistency is about making high-quality decisions under every emotional condition. When you're riding a wave of confidence, when fear gnaws at your resolve, when boredom tempts you to deviate, or when the market tests your patience with relentless volatility, it's the invisible rhythm that separates traders who build lasting wealth from those who merely chase it. Most traders view consistency as a destination, a millstone to achieve and never lose. But it's more like a daily practice, a ritual you renew with every session at the chart. Each trade either reinforces your discipline or erodes it. Much like compound interest, quietly accumulates wealth over time. Consistency isn't forged in a single dramatic win. It's built through thousands of small, deliberate choices. When you begin trading, the market teaches you about systems, patterns, and technical setups. But as you scale, it shifts to a deeper curriculum, revealing truths about yourself, your patience, your emotional limits, your relationship with uncertainty. This is where consistency becomes a psychological endeavor, not a technical one. It's not about the precision of your indicators or the timing of your entries. It's about how consistently you can adhere to your plan when your emotions scream for you to abandon it. Imagine two traders analyzing the same chart, identifying the same signal, and entering the same trade. Trader A executes confidently, sets their parameters, and steps away, trusting their system. Trader B enters the trade but hovers anxiously, second-guessing every price movement. When the market dips slightly, Trader B panics and exits prematurely, while Trader A holds steady. The outcome? Trader A wins, not because their strategy was superior, but because their execution was consistent. The strategy was identical. The mindset was not. This is why consistency hinges on control, not knowledge. The more you regulate your reactions, the more stable your results become. Every impulsive decision chips away at your consistency, while every moment you stick to your plan reinforces it. It's a mental feedback loop that either compounds discipline or amplifies chaos. But here's a secret rarely shared. Consistency feels monotonous, even dull. It lacks the adrenaline rush of revenge trading or the thrill of chasing a breakout. It's quiet, methodical, almost robotic. You wake up, analyze the market, execute your trades, and manage your risk with the same precision every time. There's no drama because drama is the hallmark of gamblers, not professionals. When you achieve true consistency, you'll notice a subtle shift. Wins and losses no longer tug at your emotions. You execute with neutrality, viewing trading as a mechanical process rather than an emotional roller coaster. This is when your results begin to compound, free from the interference of fear or greed. Consistency is also deeply intertwined with self-trust. You can't follow your plan if you don't believe in your ability to execute it. You can't scale if you don't trust your system's edge. Many traders sabotage their consistency because they lack faith in themselves. After a string of losses, they abandon their setup, even if it's proven effective over time. But every strategy, no matter how robust, will endure losing streaks. The traders who remain consistent understand this truth. They don't judge their success by a single trade, but by the aggregate of many. They trust their edge enough to let probabilities play out, measuring their progress over weeks or months, not days. This is what separates amateurs from professionals. Amateurs crave instant validation, seeking confirmation that they're right. Professionals embrace the reality that being wrong is part of the game. They trade probabilities, not certainties, and in doing so, they diminish the fear of loss because their worth isn't tied to individual outcomes. The ultimate test of consistency comes after extreme outcomes, a massive win or a crushing loss. After a big win, your ego whispers that you're invincible, tempting you to deviate from your plan. After a loss, doubt creeps in, urging you to question everything. Both are emotional extremes that disrupt your rhythm. The goal is to remain balanced, executing your plan with the same precision whether you're up or down. This isn't about suppressing emotions, it's about stabilizing them. When you can trade with the same clarity after 3 losses as you did after 3 wins, you've achieved emotional consistency. That's the moment your results begin to align with your expectations because you've stopped reacting and started responding. You no longer need the market to affirm your skill. You trust your logic to guide you. One of the greatest challenges to consistency is boredom. Once you've developed a reliable system, trading becomes repetitive, stripped of the initial thrill of discovery. Many traders lose consistency not because they fail, but because they grow restless and start experimenting unnecessarily. They take trades outside their plan, chasing excitement rather than sticking to what works. But this emotional craving can unravel years of progress in a single impulsive moment. Discipline in the mundane moments is what sustains your results. Professional traders operate with a simple mantra: if it's not in the plan, it doesn't exist. Every trade either aligns with their rules or it's discarded. No exceptions, no gray areas, because the moment you allow one deviation, your brain registers it as permission, and before long, you're trading on emotion again. Consistency also extends beyond the chart, seeping into your lifestyle. Your habits outside trading, sleep, stress management, focus, directly influence your performance. A restless night or a distracted mind amplifies emotional reactions, making it harder to stick to your plan. Successful traders treat their daily routine as an extension of their system, understanding that a calm body fosters a calm mind. Another sobering truth: consistency grows slowly but collapses instantly. You can maintain discipline for 6 months, only to derail it with one reckless trade. This is why consistency demands humility. Even when you feel invincible, you must respect the process, because confidence without humility breeds arrogance, and arrogance blinds you to risk. When should you scale? The answer lies in your emotional resilience. If you can execute 10 trades without emotional swings, whether winning or losing, you're ready. Consistency isn't proven in victory. It's proven when losses don't shake your discipline. Once consistency becomes part of your identity, growth becomes exponential. You stop chasing money, and money begins to follow your process. You stop forcing the market to pay you and start allowing it to. This is where the compounding effect of trading psychology takes hold. Small, consistent profits accumulate. Emotional calm keeps you in winning trades longer, and over time, those steady gains multiply into substantial wealth. Let's visualize the power of consistency. Imagine 2 traders with equal skill. One experiences volatile swings, big wins followed by big losses, technically proficient but emotionally erratic. The other earns small, steady profits every week, prioritizing discipline over drama. After 6 months, the first trader might be breaking even or worse, their account battered by emotional decisions. The second, though slower, has grown their account and, more crucially, their confidence. This psychological momentum compounds faster than any single trade, turning modest gains into exponential growth. Consistency isn't about perfection, it's about resilience and correction. Mistakes will happen, even with discipline. The key is to recover swiftly, without emotional turmoil. Professionals don't dwell on bad trades. They review, adjust, and move forward. Amateurs, by contrast, drown in guilt or denial, both of which erode momentum. To sustain consistency, build systems that minimize emotional decisions. Redefine your entry, exit, risk, and target, leaving no room for improvisation. Like pilots relying on checklists or surgeons following protocols, discipline in trading saves accounts. Over time, consistency evolves into intuition. Your subconscious absorbs patterns honed by disciplined focus until trading feels like second nature. You no longer react emotionally, you flow logically. The beauty of consistency is its liberating power. You stop needing to make it big overnight, trusting that growth emerges naturally from sound habits. You shift from forcing results to perfecting execution, becoming a trader who doesn't panic, doesn't chase, and doesn't quit. That's when the magic unfolds. Your results begin to compound beyond your expectations as small, disciplined decisions build unstoppable momentum. Confidence replaces anxiety, focus supplants fear, and you become a force. Not because you discovered a secret strategy, but because you mastered the one variable most traders neglect: yourself. Consistency is the seed of exponential growth, unglamorous, slow, but infallible. You don't need to trade more or risk more. You need to stay consistent long enough for your discipline to multiply. Every legendary trader started small, but their greatness stemmed not from skill alone, but from their ability to remain steady when others faltered. The next time impatience creeps in, remember, your growth is already underway. Every day you stay consistent. You're compounding your emotional strength. Every time you resist temptation, you're building momentum. One day, those small, disciplined actions will coalesce into something extraordinary. That show modest trades become fortunes, not through luck or timing, but through relentless, emotion-free consistency. Scaling isn't about adding more capital, it's about expanding your psychological capacity. You cannot manage a $100,000 account with the mindset of someone trading $1,000. The market tests not just your strategy, but your emotional resilience with every increase in size. When you scale, the stakes feel weightier. Every pip, every candle, every loss reverberates louder. But the truth is simple. Nothing has changed except the numbers. The chart moves the same. The patterns persist. The market remains indifferent. It's your perception that shifts, and scaling becomes the ultimate test of emotional maturity. It lays bare every unmastered flaw: fear, greed, ego, impatience. If you haven't cultivated emotional control at smaller levels, scaling will unravel you faster than any bad trade. Most traders mistakenly believe scaling means increasing position size the moment they hit a winning streak. But that's not scaling, it's gambling with overconfidence. True scaling is a deliberate process of building psychological tolerance, teaching your mind to remain calm under escalating pressure. Imagine you've been trading a $1,000 account, earning steady profits with discipline and focus. Then you leap to $10,000. The setups haven't changed, but a $200 drawdown feels exponentially heavier than a 21. Your calm evaporates, replaced by anxiety. You micromanage trades you once trusted, second-guessing your plan. This isn't a technical issue, it's a psychological misalignment. Your goal isn't to make more money quickly, it's to make your emotions irrelevant to the size of your capital. Professional traders treat a $100 loss with the same detachment as a $10,000 loss, viewing both as data, not personal failures. Amateurs obsess over the amount. Professionals obsess over the process. Scaling begins long before you increase your lot size. It starts with mastering the mental habits that keep you stable through every market condition. You must prove you can follow your rules during winning streaks, losing streaks, volatility, and boredom. Only then can you expand your position without disrupting your rhythm. Every trader has an emotional threshold, a point where risk or drawdown triggers rule breaking. The secret to scaling is to push that threshold gradually. Increase your position in small increments, then trade at that level until it feels normal. You're not aiming to feel nothing, you're aiming to feel comfortable, training your nervous system to tolerate larger fluctuations without panic. Scaling is like weightlifting. You build strength through incremental progress, not reckless leaps. You take small risks, navigate the emotions, learn from them, and increase the stakes. Over time, what once felt daunting becomes ordinary. But scaling tests more than your tolerance for loss. It tests your tolerance for success. Some traders crumble under big wins, their euphoria leading to reckless trades as they convince themselves the rules no longer apply. The market, however, doesn't care about your streak. The moment you let emotions, positive or negative, cloud your judgment, your edge vanishes. The best traders maintain calm detachment, treating wins and losses as feedback, not validation. Ego thrives on validation, and ego destroys consistency. Scaling also demands a shift in identity. You must think like a business owner, not a thrill seeker. Professional traders manage risk, like entrepreneurs manage cash flow, planning for drawdowns as businesses plan for lean seasons. They measure success by long-term equity growth, not weekly profits. This mindset transforms trading from a hustle into a scalable enterprise. You set measurable goals, risk limits, expected returns, process-driven milestones, and focus on maintaining consistency over months, not doubling your account in a week. This perspective liberates you from the need to prove your worth through profits. You stop tying your identity to your equity curve, realizing you are not your P&L. You are the process that creates it. This detachment empowers consistent execution, making each increase in position size feel logical, not terrifying. Successful scalers prepare for emotional storms before they strike. They don't wait for chaos to test them. They simulate it. They trade demo accounts with larger sizes to feel the pressure, visualize losses before they occur, and rehearse discipline like athletes perfecting their craft. This mental preparation builds resilience, ensuring they don't freeze when real money is at stake. They flow. Scaling isn't about making more, it's about lasting longer. The game isn't about being right, it's about staying in long enough for your edge to compound. To achieve this, redefine wealth. For many, true wealth isn't just financial, it's emotional peace, the freedom from fear and obsession. You find that peace when you trust your process so deeply that outcomes no longer intimidate you. Scaling carries responsibility. The more capital you control, the more discipline you owe yourself. The biggest losses stem not from poor analysis, but from abandoning proven rules under pressure. Scaling also exposes your relationship with fear. Fear of loss, fear of missing out, fear of squandering gains. These fears never vanish, they evolve. Your task is to recognize them and act despite them. Every disciplined trade in the face of fear expands your psychological limits. Over time, the numbers lose their emotional weight. A $500 profit feels no different from a $5,000 one because you've trained your brain to prioritize process over outcome. At this stage, you're no longer trading for the dopamine rush. You're trading as a craft, with the market as a mirror reflecting your growth, not a foe to conquer. The final stage of scaling is paradoxical. You detach from the need to scale at all. When you stop obsessing over bigger profits, they begin to flow naturally. You operate from clarity, not pressure, understanding that wealth grows not from doing more, but from doing the right things consistently. This mindset turns small accounts into fortunes through patience, precision, and humility. You build confidence through process, expand through discipline, and protect growth through restraint. The breakthrough isn't a new strategy or a perfect trade. It's the moment you stop forcing outcomes and trust the rhythm of your process. That's when you truly scale, not just financially, but as a trader who embodies the discipline wealth demands. Because in the end, wealth isn't born from one monumental trade. It's forged through thousands of disciplined decisions, executed with unwavering patience and precision. It's built by staying calm when others panic, confident when others doubt, and consistent when no one's watching. That's the winning mindset, not one that chases fleeting success, but one that grows quietly, compounds daily, and evolves endlessly.